Ladies and gentlemen, how we doing? I hope you're doing great. So this is Matthews from M&F FOREX Traders. This is specifically for the mentorship group, for the premium members. This is specifically made for you guys. Okay. So this is something that you have to be looking at every time you're in doubt, every time you are feeling not confident. Okay, so let me just run you through the setup. Okay, so you want the market to be in either short-term or long-term uptrend. Okay, so for example, in this particular case, we have a dual resistance. The market goes down, then you have a market breaking this double top right there, and then the market drops a bit, then market forms what we call an MPL. Okay, then it drops down like that. So the next thing that you want to see is market now coming back to your level. So in this case, I'll try and make this one an SR flip. Then you have the market respecting this level here once, twice, and 3 times. Okay, and then it gives you a little bit of confidence, and then goes up to that level, and then it drops. Okay, of course it won't happen exactly like this. This is just an illustration to show you how the setup is supposed to look like every time you're looking at the chart. Okay, it won't always be the same. This won't always be there. The MPL won't always be there. There'll be setups. Actually, most of the setups don't even have an MPL. Okay, so where price reverses from is where the fresh supply or demand zone is. That's where the market will reverse from. So guys, you forgive me, my voice is kind of hoarse. I have corona. I'm sick. Okay, so let me just do the labeling, basic labeling. So this is R1. R1 meaning first resistance, and then we have a second resistance right there. So you know what this does? Once retail traders see this, it will prompt them to actually want to sell on the third touch, and then guess what? The market pushes to the upside and breaks this level here. Okay, so let me just put a line here. So the market will break this level. Okay, once the market breaks this level like that, then we know that people have been trapped. Okay, and people need to get trapped because orders need to get filled. So this is what you call a dual resistance, QML. So this is our QML. This is what we call a dual resistance, QML. So you have your QML here, right? What's next? Then you have your low here and that break of structure. Low and break of structure right there. Okay, this is a low and break of structure. So this is a high, low, and then a higher high. So this is the high, the ultimate high. Okay, okay. And then at this level we have an MPL. Okay, so something like that. So the market is in an either short-term or long-term uptrend. The market gives you a high and then a low and then a higher high and then breaks structure. Then the market forms what? A lower low. So these are the things that you're going to find in the past. Okay, so these are the things that you're going to find in the past. So this is what constitutes the past. So this is the past. Okay, you guys remember in the past, what do you have in the past? So in the past, what we have is this. So we have a QML, we have the low and breakout structure, we have the high, we have an MPL or not, then we have the lower low. So this is what constitutes the past. Okay, so this is what we call the past right here. Okay, so this is the past. So right here, this whole thing is the past. Okay, this is the past. I don't want to actually put this one here. So that's the past, and then we move on. So remember, that's points to mention here. So when you see a dual resistance being formed here, it tells you that there's a higher chance of that particular setup working. But of course, it doesn't mean that it's automatically going to work out. No. You always remember, guys, there's no certainty in the market. Anything can happen at any particular time, right? Yeah. So when you have a dual resistance, there's a little bit higher chance of that particular setup working out. Number two, you want to pay attention to the candlesticks that breaks this low here. The candlestick that breaks this low here is very, 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 very important. So you want those candles that will cause an imbalance, like that's momentum candle. You want to find a momentum candle here. So this can on a lower time frame, this can actually appear to be, let me just for example, this can be a bullish candle, right? This can be a bullish candle like that. Yeah, this can be a bullish candle here. Let me just remove this. This can be a bullish candle. Okay, then now we have a bearish candle. Okay, that breaks structures here. Then we have a bearish candle that engulfs this candle here. Okay, this is fake, but let me just make it like, yeah, something like this. All right, so you have, this is what you call a bearish engulfing pattern. So you want to see momentum candles here, okay, because you know that once we have such a move, it creates an imbalance. Okay, it creates a level where the market is supposed to come back to. You understand? So when market is balanced, the market will be in a consolidation. Now when market like does something like this, it means that supply has exceeded demand, therefore the market is going to go down. Okay, so as it goes down, we assume that there's to be orders which will need to be filled here by the smart money, and at this level here, that's why we're going to wait for price to return so that it can collect those unfilled orders from that level. So we wait for that return. Okay, so the market will come to you in different ways, but what you want to concentrate on is like we've been doing most of the times, we want to find a fake out. Want to find a fake out. So a fake out is just the way the market will be trying to trick the retail traders into doing this thing and while doing the other, right? So at this level here, you can have a, a, an equal highs. Here we have equal highs where you have market giving you support, now resistance, 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 right? So market usually has to take that resistance out before it can actually drop. Okay, so this here is R1, R1. So this here is the approach. How is the progress? Sorry. Okay, so the progress, we were looking for a fake out kind of progress because we understand it, and we understand better, and it also occurs more commonly, more frequently than the diamond or the compression. Okay, So when we have this, then meaning our progress is complete. So progress, what do we have? So in this case, this is the fake out version. So just say fake out v1, meaning fake out version 1. Okay, so our pass was complete and our progress is complete as well. We have a fake out v1, and then the last part, which is the the approach. So one thing to note here, always, not always, most of the times you actually realize that there will be a nice big momentum candle that actually comes to this level here. There'll be a nice green candle here breaking this liquidity above here. There'll be a nice candle breaking the liquidity above here and taking everyone out here. So what we call a Marubozu candlestick. So once you see that, then you can get ready to actually sell. Okay. Of course, we are going to wait for confirmation. Until we've seen the confirmation, we won't do anything. So once we see, so it's actually very important. Make sure that, so when you see a fake out there, when you see price being taken out, this level is being taken out by a big momentum candle, that actually tells you that price is headed to a tradable zone where market can actually drop. So we just wait and we wait for price to actually give us confirmation. So on confirmation, on the approach here. So on the approach, what we want to see, we are looking for, reversal candlestick patterns. Okay, so we're looking for, in this case, we're looking for a bearish pin bar, which we call a shooting star, a pin bar. We're looking for bearish engulfing candle. Okay, what else are we looking for? So these are our confirmation for entry. So we can have a rising wedge. Okay, we actually also have a QML. Have a QML actually right there happening there on the lower time frame. You can have double edge, like you can have what else? These are the most common kind of confirmation that we're going to look for here. Okay, so these are the things we're going to wait for. Until we see these things, we won't actually take the trade, because we might just be entering into something that we're not even prepared to actually handle. So we always wait for confirmation, and once that happens, then we actually sell. So usually the market comes to a level here where there was an order block. So how do you identify an order block? So an order block is, for example, a bearish order block is just the last candle before the last bullish candle before the bearish move. The last bullish candle before the bearish move. Okay, that bearish move that broke the market structure here. Okay, so we're going to grab that. For example, if you have something like this, then just grab this and then extend it to the right side. This is your order block, and we literally just wait for the market to actually come to this level. Okay, because we've seen that this is actually what, a bearish order block right there. Okay, so of course below here we have what, liquidity. Remember, this is our liquidity zone. This is our liquidity zone above here, remember. So that's where we have to wait for those people to be taken out. And then this is our, so it can be a rally base drop supply zone, or it can be a drop base drop supply zone, depending on the kind of presentation that you have, right? So if you're looking at this drop base drop, then you can say it's a drop base drop supply zone. If you're looking at it in a holistic way, where you're looking at the whole picture, then you can call it an RB, this is like rally base drop. So it all depends on how you're going to look at it. Okay, so price has broken the liquidity above, it has come to your level here. You don't just trade blindly, you don't just enter blindly here. No, you wait for price to show you rejection. You want to see price being rejected from that level. How do you see that? How do you tell that the price has been rejected? You're going to see a nice candle wick rejection with only a small body with a big wick, long wick, or you could actually just going to have a bearish engulfing candle, right? Once you have that, then that's your confirmation to sell. In this case, we'll sell from here, right? We'll sell from here. And then what we'll do is we'll put our stop loss above our bearish order block. Okay, we'll put our stop loss just above the bearish order block right there, and then our target is on the next fresh demand zone. That's where our target is going to be. Okay, so this is how it is, guys. Therefore, meaning the setup is complete. Your setup is complete, and if the market goes in your favor, then you enjoy. This is all we trade, guys. Every time looking at the chart, this is what I'm looking for. Okay, there might be some slight variations, but basically it's all the same. But however, remember that it's all probability. There is no guarantee that this setup is going to work 100% of the time. No, you have to understand that and actually be able to internalize it and really believe it, because if you don't, you'll be prone, you think that it's going to work 100% of the time, and then you want to risk a lot of money per every trade, and then you'll be disappointed, you lose money. Yeah, so there'll be nice setups like this, but they'll still fail. So the key is in consistently identifying this setup. You need to be able to objectively identify these setups every time. Take trades that meet your criteria. The beauty thing about our QM strategy is that it gives us a high risk to reward ratio. You always take trades that give you more than 1 to 5 risk to reward ratio. That's a good part. So even if you had 5 losses in a row, just one trade that gives you 1 to 6, as long as you're respecting risk management, you still be okay. All right. So please make sure that you respect your risk management. Be consistent with how much you're risking per trade every time. Remember that. Okay, that's very important, because it don't actually be very difficult for you to actually recover from your losses, because it will be easy. You just need to get one winner like that. But if you're not respecting risk management, it's going to be very difficult for you, because you'd have lost so much money on those particular trades, just that even just one trade won't actually be able to cover up all those negatives. Okay, yeah. So remember, guys, make sure that also this high here, make sure that this high, it doesn't have any levels where it acts as resistance. So you can put a horizontal line here, and then zoom out of the chart, then go to your zoom out, and then look to the left side. Make sure there are no levels where the market is coming to this level where the market is actually being touched like this, for example. If you have cases like that, then that's likely to actually fail because to be used as liquidity. Okay, avoid that. So the one with the dual resistance here, it gives you more confidence actually. Okay, remember again, the candlestick that breaks this, the candlestick that actually breaks this is very important. You want to find big candlesticks breaking structure here. That tells you that there's smart money in the market and there's a higher chance of price coming back to this level than dropping. Very, very important. Always wait for price to be taken out here. And when you see price being taken out by a big momentum candle here, it also adds confluence. And wait for your confirmation here with weak rejections, bearish engulfing patterns, a rising bar compression. Wait for that. Once you see your confirmation, take a trade, put your stop loss above the bearish order block, and then just set a target there. Then manage your trades. Again, there'll be times when you don't have an MPL, you only have the higher high. That's where your supply zone is. Guess what you do? You enter from where? From your higher high right there. That's where you're going to actually enter from. And then your stop loss is going to be above the higher high. It's going to be different when you don't have an MPL. So for example, meaning it's going to be something like this. Okay? It's going to be something like this, meaning even the trade, I was going to take a trade from here, then my stop loss is going to be above my higher high right there. Okay, my higher high above there, right there, and my target is going to be the same. Okay, so it's going to be different when you have an MPL and you don't have an MPL. When you don't have an MPL, this becomes your supply zone there. If you have this, then you look for that. All right. So for now, we're looking at this one, which doesn't have, which has an MPL. So you guys, I hope you really understood something here. So let me just show you on the chart, on the real chart, what's happening. So please, if you have to take a screenshot, stick it somewhere, print it out if you have to. Okay, this is gold, guys. So let's go to the chart. I show you what I'm talking about on gold right now. Let me go to the 30 minutes time frame. Yeah. So I'll just be pointing out everything. So let's go. So remember, I said that you want to make sure that the market is in a short term or long term trend or uptrend in this case. So what we have here is market making series of higher highs and higher lows. Of course, this is gold on the 30 minutes time frame. You can see that of late we've had a bearish gold. It's been selling for some time now. Okay, so meaning looking for shorts is actually not bad. So after that, we have a retracement. This is a retracement which looks like an uptrend. And then if you look closely, you're going to realize that the market actually gave you a geo resistance QML, and then it gave you a low, and then gave you a higher high right there. After that, the market gave you a lower low. Okay, so remember that gives us what? A complete QM. So we have a QML, we have a low, we have a higher high, and break of structure right there, and giving us a low. That's done. The past is done. Remember how to discuss in the past? We're looking for the QML, low, higher high, or MPL. If it's there, then you have a lower low. So remember what I said. In this case, it's not MPL. So it won't always be there. It won't always be there. So then that's done. The next is the process. So in this particular case, we have what we call just like the previous one, is the fake out. So you see what happened. So we had a resistance here and then a resistance right there. All right. So we had two resistance, and then guess what? We have the market coming to us with big candle. Remember what I said? Big candle right there. Okay, tells you that there's presence of smart money there. And also here we had a nice big candle there, drop, and then further drop. After that, the market actually just came and broke above this liquidity zone, and guess where it went to? Our rally base drop supply zone. And then that's where we have what? We have our supply zone right here, and then the market rejected. If you can just zoom in a little bit, you realize that the market actually just came there and gave us a nice rejection. So if you can go to the lower time, let's go to the 15 minutes time frame and see what is happening there. So let's go to the 15 minutes time frame. Yeah, so from here we can see that the market actually just gave us a nice weak rejection there, and then the market dropped with a nice bearish engulfing pattern, meaning our entry was going to be around this level right here on the next candle open here. That's where our entry was going to be, and this market is actually ready right now. I actually have to enter it, though usually the spreads are usually wide during this particular time, because this is 0-1 that is be in the morning. Okay, so it's like that. You wait for price to come to this level. Once price comes there, then gives you a confirmation, and so that's the approach. You see the approach, we had a nice marble candlestick pattern, breaking structure, and then coming to our level here and giving us a rejection. Then we actually enter, we sell. So stop loss above the higher high right there, and our target is going to be the lows here. This low here, I'm targeting this low here. That's why we have what? We have a fresh demand zone here, right there. So that's our target. So if you look at all that, so our risk is about 3 pips. This is on the 15 minutes time frame, so it's like 3 pips. Let me just recalculate. So risk is about, yeah, about 4 pips, and our target is how many pips? Our target is about 43 pips, and that's a 1 to 12 risk to reward ratio, 1 to 12 R. Like, that's massive, guys. 1 to 12. Because of the smaller stop loss, you're going to use a bigger lot size, of course risking the same amount, and it can be a very beautiful trade. So you guys, I hope you find this information valuable. Whenever you find yourself not understanding the concept, please come back to this video, rewatch this video, because it's very important. All right, so you guys, if you have any questions, please feel free to reach out to me via Facebook, via WhatsApp, via our various social media platforms. All right, guys, may God bless you. Until next time, goodbye.